Hey, Mark Lavelle and Associates. So getting ready to take a look at, are we in a recession? Are we getting ready to go into a recession? Or are we actually getting ready to come out of a recession? And these are things we really need to start educating ourselves on now so that we can be prepared as they happen in the future, right? So a recent article by Lance Roberts, who is a strategist, if you get a chance, look up some of his work. He's very good. And as well as some of my own opinion on this and my own experiences on this, I'm going to talk about exactly what's happening. So Lance Roberts just recently wrote an article about the banking crisis is the first evidence of a recession. And historically, that is absolutely true, right? And people don't understand that. So let's look at everything that's going on. Last month, we had Silicon Valley Bank that went under for different reasons, but it caused a ripple effect where the Federal Reserve had to come in, right? And now today, we had First Republic Bank that was just taken over by federal regulators. A large portion of that was sold to JP Morgan because they were getting ready to go under. And it's kind of causing a rippling effect all the way down through smaller banks. So let's take a big look at what's going on and then kind of prepare ourselves. Number one, why is this happening is because people are losing faith in smaller banks. They're afraid they're going to lose their money by leaving it in there. So what they're doing is they're pulling their money and they're putting it into bigger banks that they think are maybe too big to fail, which isn't necessarily true, right? But it's just maybe a little bit more secure. But anything can fail. You got to look at some of the histories of those big banks too. People are also starting to think of, hey, well, I'll pull that money out of a smaller bank and put it into a maybe different investment vehicle, maybe a fixed investment or something else, because I just don't trust that my money is going to be safe there, so I'd rather put it somewhere else. So now we got to think about it. What's going on with those smaller banks? Well, now those smaller banks, as the feds raise the rate, right, the federal interest rates and all that, as the feds do that, understand that the Federal Reserve rate says banks have to have a certain amount of money to keep on hand at all time, or else they have to borrow that money from another bank at a certain percentage rate. Well, as money is being pulled out of these banks, number one, they don't have money to go ahead and invest. They don't have the money to go ahead and give out to people because they have to keep a larger amount on hand. And then as it shrinks, they have to borrow that money that they need to meet the Federal Reserve rates at a higher interest rates. That's what's putting these smaller banks out of business, is the fact that the federal rates have greatly increased over the last several months, right? And people just can't keep up. So now let's look at the whole compounding issue of it, right? So as the feds raise interest rates, right, that means it becomes harder for people and businesses to get loans. With the current conditions, people and companies now have less money to spend on services and goods. So in order for businesses to survive during these times, they really need to do what? Well, if nobody is paying their bills and people are not buying their services anymore, the companies are faced with some really, really big problems. Guess what? The company still has to pay for inventories, right? They still have to buy supplies to make their products or to do their business. At the same time, things are getting more expensive for the companies as well. Electricity is going up, power is going up, they still have to pay insurances, they still have to pay operating costs, and then guess what? They still have to pay their employees. Why? Because you can't pay employees on credit. You have to pay employees on cash. So what happens in these situations is banks now, or not banks, but the companies have to go to banks and get extended loans of credit, but it's more expensive for them to get these lines of credit. Leads to one thing where companies only have a couple of options, right? Number one is the layoffs. They're going to lay people off because they can no longer afford to keep them employed. Laid off people have less money to spend on rent. Laid off people have much less money to spend on vehicles, goods, and services, let alone food at the grocery store. Number two is anything that's not an absolute necessity, they're going to be cutting that as well. So that you're looking at people who give the companies technical advices, they'll be cutting that. Advisors, they'll be cutting that. Cleaning crews, they'll be cutting that. And a lot of times this is going to put people in the same position as laid off people. So we're just building and building on this compounding problem as we move further and further down the line, right, of where our country is at the current time. So most people would think that this is actually the recession, but it's not, right? And it's what we've been coming through, and we've been looking around and we've been saying, are we in a recession? Are we not in a recession? We're really not sure. Well, the banks starting to fall, some of these smaller banks starting to collapse, have historically been the result that a recession is coming. Why is that? So people think, hey, okay, so the Feds have been raising the rates and now they're going to reverse it, right? So what happens is when the smaller banks start to collapse, the Federal Reserve has to go, okay, we've been raising our rates, we've been hiking everything up. Now we need to reverse our position and lower the rates. People think this gets us out of the recession, but in fact, this is just the first sign of the recession. Why? Because the only reason the Feds are reversing their decisions is because they realize something is broke. It's already broke. It's just a reaction to something being broke. Kind of like the old TV when it wouldn't work anymore and just lines would go up around the side. You would do what? You'd hit it on the side until it stopped rolling and it stayed still, but you knew your TV was broken. You needed to replace it. Or when you beat on the back of a remote control to try to get it to last a couple of more days before you have to change the batteries, right? It's already broken, and what I am doing temporarily, hitting the buttons, smacking the side, or reversing my stance if I'm the Federal Reserve is just to say, hey, that's a problem. We broke the system. So that's the first thing. So it's a good sign that, hey, we're not in a recession yet, but we need to look at when the Federal Reserve does decide to reverse the policies that it's had and lower the rates, maybe entering that recession, be on the lookout for that, right? The second time that the Feds would actually reverse the rate again and lower it again would be the sign that we're actually coming out of the recession, because the first one is, hey, we broke it. The second one is, hey, we need to get it fixed. We need to make things easier for people. So what's led to this whole problem? Well, in my opinion, this is, and not just my opinion, but people in the industry, this has been coming a really long time. We had a market that since 2010 has been absolutely incredible. It's been on an upswing. We had a couple of down years, but in the industry the last few years, we've been sitting around and we've been waiting for this dip or this reset to occur, and it never really occurred. I mean, it would tank temporarily, but then it would bounce right back up, and we never entered this recession because people were always trying to do something to fix it instead of letting it happen naturally. And then we had the whole COVID stupidity come along. And when I say COVID stupidity, not the stupidity of the disease, but how we lost our mind as a society where people could no longer work. They were getting money from the government. Places were not collecting rent. And people decide, well, I don't need to work anymore. I'm just going to resign, or I'm going to work from home where I'm not as productive. So we went into this whole thing where people were getting paid to do absolutely nothing, right? Except stay home and watch TV. And then when we got out of that, when we came back, after that whole year of complete chaos, we came back, and that's when it should have hit. But guess what? It didn't hit. We actually accelerated on it. I think people were still living on hopes and credit at that time instead of, money's going to stop coming in. I'm no longer working. I better watch it. But I think people kept their foot on the gas thinking the money was never going to run out, or that the companies were never going to ask for their rent. Or, I mean, your mortgage lenders and all that, or your apartments were never going to ask for their rent. And I can just keep sailing. It doesn't work like that, right? So I think the bounce back after COVID was something that really didn't help us that much. And then, honestly, the last thing is we stopped believing ourselves. We stopped believing our own eyes. We stopped believing our own ears. And we started listening to everybody else except ourselves. Like, we knew it would cost more money to run our household. We knew that going to the grocery store was harder now. We knew that filling up our cars took more money, right? So we had more money, we had less disposable income. But this is not a Republican, a Democrat, independent conversation, because it doesn't matter on who you are, right? But we started listening to politicians whose jobs depended on us not being in a recession, right? So again, this is not a political thing, but think about this. No matter what political party is in office, when a recession hits, they're going to tell you that a recession is not there. Why? Because their jobs depend on it, right? No matter if you're a Republican, no matter if you're a Democrat, if you're the power in party, when a recession hits, you're probably going to be out of a job in 2 years. What happens when you're out of a job? Well, you're just like every other American at that point, right? They don't want to be out of work. They're not going to tell you something that's going to put them out of work. But we stop thinking for ourselves. We stop trusting ourselves. We stop believing our own senses. And we said, well, the TV is telling us all right, so it must be all right. We got to stop that. That's why, the education is so important for people to be properly educated on these things. And when it comes to finance, we're just not, right? And that's why if I didn't believe that education was the key to this whole thing, I wouldn't put these videos together for you to try to educate you on what to be aware of. So be on the lookout for if that first reserve, the first Federal Reserve change, reverses courses, may actually signal us going into a recession. Hopefully we will not go into one, right? But unfortunately, when some things are just a long time coming, they're going to happen. So hey, be sure to like and subscribe, follow these videos, and pass them on to your friends, that it can help them, that we can get through this together.